Hello, hello. We're here for the Capital Spotlight podcast with your host, Craig McGrother, with the one, the only, Mr. Patek Philippe, Mr. Suit Supply himself, the co-founder and principal of Lone Star Capital, two-time author, Rob Beardsley. How are you today, sir?
I'm good. I'm dialing in from Warsaw, Poland.
Very good. Well, we'll actually get into it. I don't want to dox you just yet, but very fun that you're abroad. So we'll talk about travels. We have a jam-packed episode today. Just real quick for the agenda, we're going to go over through a little econ. We're going to go through CPI update and also other news with student loans starting to be paid back again. I believe it's October. So we'll dive into that. And then a really interesting article, which we kind of dove into before, but sponsor skin of the game, something that we've kind of behind the curtain spoke about a lot. So that'll be really fun to dive into. Things to avoid today in today's market as an investor. So I hope for those whom are watching that are, passive investors or looking to, put their money in the market if they've, been sitting on cash, hopefully you'll find that useful. And then what product you would stay away from. So product, i.e., on the Lone Star level, what type of assets, buildings, vintage, you name it, that we would not buy. And then finally, on a personal level, we're getting into your fun vacation, where you are, and then something that's just near and dear to my heart and topical, because last night I got dinner with some, successful entrepreneurs, and just about the value of your network and being around people that are doing big things. And then finally, want to get into Rob's goals before turning 30. And since I'm hanging onto the 30s by the hair of my chinny chin chin, my goals that I want to achieve by the time I turn 40. And then Rob actually got diagnosed. This is on a heartfelt note with a disease, a sickness. So we'll get into that as we wrap up the episode. So then send your thoughts and prayers and love to Rob's way as he goes through these trying times. But without further ado, let's dive into it. CPI, I know you wanted to break that down real quick, and then also how the student loan forgiveness is up soon. And let's get into it.
Sure. Yeah. So I didn't imagine us spending this much time on every episode talking about macroeconomics, but I do think that there's interesting things going on in the economy and in the market that are certainly will always have an impact on real estate. So I think it's interesting to touch on these topics as they come up. So specifically, two things that you and I wanted to discuss today are first CPI, and talking about how, at least in my opinion, in my view, inflation is coming down rather rapidly. And I think that I've been saying this for a long time, actually, that, hey, I know everyone's worried about inflation, but trust me, give it enough time, everyone's going to be worrying about deflation and not inflation. All right. Inflation is going to be in the rearview mirror. Certainly, we saw a lot of inflation as a result of everything that was happening around COVID. Well, on the supply side, on the demand side, and then, of course, monetary policy. So specifically with CPI, we've had over the last 2 months a 0.2% month over month CPI increase, right? So if you take 0.2% and you multiply that by 12, so you annualize it, that's 2.4% annual inflation. Does 2.4% sound like a scary inflation number? No. Yeah. So, and that's 2 months in a row now. And so that's positive news for sure. So for those people at the Fed that are thinking of raising rates, I sincerely think that that's a mistake and unnecessary. I think the brake pedal is sufficiently pressed on the economy, and we're going to see deterioration in GDP and inflation, which is exactly what they want. They want to press the brakes in the economy so they can cool things off, cool down inflation. It's much harder to kind of reel in inflation. No, I'm sorry. Once inflation kind of gets going and it's out of control, it's much harder to reel it in. So I understand from the Fed's perspective why they're pressing on the brake pedal so hard. The other component of CPI that I think is interesting is not just the fact that we've had 2 months in a row of 0.2% month over month inflation. It's also that one of the big factors of CPI is shelter or real estate, right? Rents and home ownership. And rents on average around the country have flattened and have gone down a little bit. Fortunately for us at Lone Star Capital, we invest only in Texas, specifically Dallas, Houston, and San Antonio. And in the right pockets in those markets, rents are still going strong and still moving higher. However, on a national average basis, rents have flattened or gone down. And so that has an impact on CPI. However, there's about a 6-month lag in the way that rent is reported in CPI. So even though today we know that rents are going down, CPI doesn't know that yet. So we're going to see that impacted, give it another couple months, 3-6 months, and we're going to feel that fully in CPI. And I think CPI is going to even go below 0.2% month over month. And then we'll really have inflation beaten down. So yeah, I don't know if you have any thoughts to add, but that's my little interesting inflation update, kind of my rationalization for why I think the Fed shouldn't raise rates anymore.
Yeah, no, it's a great take. And I think one thing to dissect is, as a country, we are incredibly vast. So this land is big, and different locations, different states experience inflation differently. And some areas have higher inflation, some have lower. You think about Florida. Florida is going through a lot more inflation than what we would see in other places because the population growth, or places like Texas, Tennessee, Phoenix, Arizona. Now, Phoenix is struggling to live on rents, but some places are climbing quicker and some places are going down harder. So it's the averaged out. But to the point as to why we select to be in certain markets, it's for a reason. Being in more rural areas, inflation is probably slowing a lot quicker. And then being in, places like New York, it feels like if you're going to get a cocktail, you can't buy one for less than $25 these days. So, and then also it just generally with, you said deflation, I do think the amount of money that was printed's got to stick somewhere. And I think places like real estate, shelter, housing just doesn't get cheaper as time progresses. And, we love the niche that we're in, the workforce space, where it's not the highest end where that could take a hit, and it's also not the lowest end. So kind of playing in that middle space, which is just part of our kind of mission, just makes a lot of sense and is very stabilized. So those are kind of my 2 cents I wanted to add to your point. And I mean, let me know what you think about this, but what areas and I guess markets do you think inflation is strongest, and what places do you think are getting hitting the hardest?
I would say, to your point, bigger cities probably have more inflation, smaller areas probably experience less inflation. And there's also maybe a conflation of growth, like true growth by way of population growth, by way of wage growth, and then what is actually just inflation, which is just prices increasing without real demand being added to the market. So yeah, I'm definitely not an expert on that, but I think that, like you said, we're in the right places. I think Texas overall is set to perform really well. Not to get off track on our discussion here, but one of the benefits of everything that's happening in the market, specifically the tightening of financial conditions, is it's gotten very difficult for developers to build new product. And that's great for us as owners of existing product, right? Because this game is all about, like everything else, supply and demand. But I want to quickly transition. We both mentioned the word deflation, and something that is interesting and coming upon us that is deflationary is the resumption of student loan payments, right? So as you mentioned in the intro, student loan payments are set to restart in October with an average of $350 per month as the average payment. And economists believe that equates to 25 basis points of GDP. So that right there, once that switch flips in October, there's another bite out of GDP right there, 25 bips. So that's going to be deflationary, right? It's taking money out of the system. So let's say you're an individual who was, instead of spending $350 per month on your student loan, you could have bought a car and have a car payment, or that was an extra, couple splurge date nights that you went on or something like that. Now that restaurant is not getting your money anymore because your money's going towards debt service. So that's deflationary. And that's, again, exactly what the Fed wants. Is they want deflation. They want to bring it down. And just to kind of play it out for people as an example, right? If that person takes their $350 and instead of going to the restaurant, they give it to debt service, now that restaurant doesn't get the $350. Now they maybe hire one less wait staff or something like that. And then that's one less person who has a job. And then that person who doesn't have a job anymore, now they don't have money to spend in the economy. And it's a trickle down effect felt all throughout the economy, which results in what? A recession. So I'm not doom and gloom here by any means. I'm not saying we're going to have a big recession, but recessionary effects is exactly what the Fed wants and why they are raising rates and causing all these things to happen. So we need it as a country to go through this austerity measure and to digest and get over this inflation. So I'm actually I'm not sure. I'm not an expert on student loan repayments or anything like that, but it sounds to me like maybe a good thing. I mean, people should probably be paying their debts, right? And it will help slow the economy down a little bit.
Yeah, I can't say it's a good thing or bad thing. It's just was inevitable. And, we're not going to just forgive this for indefinitely. So it needed to happen at some point. And, exactly to your point, the trickle down effect. And I was just kind of thinking about this on the fly, but I do think around, because that's going to happen start of Q3. I do think by the end of Q1, we'll technically be in a recession, heading into an election year, which will make everything a little bit interesting. But that's possibly when we could see and expect the first rate cuts to perhaps occur once we are in a recession. They always kind of cut them a little bit too late. But, to the point, we've been in a bear market for a very long time. The game has been on easy mode for a while. The money printing was real. So there's just going to be a balancing act. And it is unfortunate that places like, restaurants, retailers, boutique stores, that extra $350, that's, a new outfit. That's, exactly like someone said, a car payment. If you're selling cars, well, next thing you know, hey, yeah, you can afford this, Toyota Camry or, Honda Civic. That's $350 a month. Great. Well, now that gets taken out, are people, just going to turn the car in? Are they going to have to shave some expenses elsewhere? I mean, there's going to be a tightening coming. So it will be interesting to see how that transpires. I guess, a lot of tenants as well are, folks who are probably, and this is people that are under 40, I would imagine, that have student loan debt, typically speaking, if I'm just logistically kind of playing that out. So it'll be interesting to see how that affects the economy because, people whom are millennials or Gen Z, what do? They like going out, they like spending money, they like having a good time. So it will be interesting to see as that section and segment of the economy now has $350 less to play with monthly. So it will have an effect, and that could be people's social budget for a month. Everyone's circumstance is different. So eliminating that will certainly shake things up a bit and normalize everything and kind of maybe help us bottom out a little bit quicker, perhaps.
And speaking of election year, as you mentioned, that's always an interesting time because people play a bit of a wait and see game when it comes around to the election. So what we've been through over the last, call it almost a year now, and probably another year ahead of us of kind of slower transaction activity. 2020, the back end of 2020, 2021, and early 2022 were super hot years. There was record-setting transaction volume. Gangbusters. And then things really slowed in the second half of 2022, and 2023 has been slower as well. And I think a lot of people in our industry are looking to the future, right? They're sitting on piles of money and they're talking about the opportunity that's coming their way. They think they're going to be able to buy deals at a discount, and they're kind of waiting for 2024 a bit and thinking that there's going to be better opportunity there. But in November, we have an election in 2024. So that's going to also kind of make people want to sit on their hands a little bit. That's what we usually see is people kind of, they want to, it's like a race to do deals up until the election. And then they want to stop and take a pause, have the election go through, and then the dust settles. And then usually NMHC in end of January is when everybody relaunches their deals. And for those that aren't familiar, NMHC is the largest, it's the National Multi-Housing Council, and they have an annual meeting every year at the end of January where everyone in the industry converges, and it's a big opportunity for everyone to get together, specifically brokers and investors, to like us, to kind of see the deals. And so if you're a seller, it's oftentimes NMHC when you launch your deal for the first time, and you have your broker pitch your deal, and you're off to the races. So I think there's going to be a pickup in activity in this upcoming NMHC, which would be January 2024. And then I think it's really going to pick up January 2025. That NMHC, I think, is going to be real busy.
Yeah, I was just thinking to myself, shoot, like mentally thinking about it unless you're a forced seller, which a lot of debt is maturing coming up, there's not going to be as much transaction volume, and people are still going to have to stomach the pricing difference. So yeah, I mean, transaction volume and acquisitions will likely be slow for, I hate to say it, but probably another 16 months. Now that we're kind of talking it out, would you agree with that?
I'm hoping that things pick up in like 10, 12 months. I hope so. But
Basically, the turn, basically H2 2024 is your hope.
yeah.
I'm gonna think like Chamath and just think rates are gonna be higher for longer, and transaction volume will be lower for longer, just to mentally hedge, and anything else that beats that is a bonus, I suppose.
Did you say that Chamath Palihapitiya is going to be a guest on our show?
Yeah, I did. He's actually coming on. He was begging, and I had to turn him down. And I kind of denied him a little bit here and there. It's like, no, you can't come on this week, and he keeps on following up with me, so he's very persistent.
Well, he has to go after Dasha, right? Dasha was a much more valued guest, so he has to.
Correct. Correct. Yeah, no, people wanted to see and hear from her a lot more than him. So
Give the people what they want.
exactly, not what they need, but what they want. Awesome. So transitioning now, well, I guess I'll ask any final thoughts on that subject.
No, no, let's transition.
Cool. Yeah. So transitioning now, things to avoid as an investor in today's market. So I do think this is interesting to think about. We have, our kind of rigid set of guidance for underwriting and things to invest in. But I guess maybe take it just from a real estate perspective. What would you avoid investing in today as an LP investor or capital partner to partner up the deal for? And then outside of real estate, what would you avoid investing in as well currently?
So specific to multifamily, which is my area of expertise, of course, I think it still makes sense to avoid problematic Class C property. So this has been the case for, in my opinion, a long time now, because risk has been mispriced in our industry for a while, where people were paying essentially the same cap rate for a Class A deal and for a Class B deal and for a Class C deal, right? And logically speaking, if they're all three the same price, it makes sense to buy the nicest property, right? It only makes sense to buy a lower class property if it's cheaper, right?
Yeah.
So I think that is still somewhat the case. We've seen dispersion come back to the market where there's now, higher cap rates for C, then slightly lower for B, and then slightly lower for A. So that dispersion and that steepness and that risk curve is coming back, but I still don't think it's steep enough to make sense of buying really low class C class assets. I do think it's coming though.
So can you please, just for the audience, to break it down the most simple way possible, can you define Class B, C, and A, please? Just so we have context for that asset class or classes.
Yeah, sure. I think this is actually, I'm glad you asked this. So at our firm, we look at it, you can get as complicated as you want, but we look at it in kind of two vectors or two axes. One would be the quality of the property, meaning the real estate itself. And then two would be the quality of the location, right? And so, for example, we subscribe to Yardi Data Services, and that's where we get a lot of our sales, loans, rent, comp data, all that good stuff, demographic data. And they actually, not to say that Yardi's perfect, but they will classify the property's physical improvement rating on an ABC basis, as well as the location rating on an ABC basis. So that's exactly how we think about it as well. So I would say Class A location would be 85K plus median household incomes in a 1 mile radius, something like that. Maybe even, it really depends where you are. So don't take this with a grain of salt. Different incomes for different areas are good benchmarks, but for us in our Texas markets, I would say somewhere about around 85 to 100K minimum for an A location. And of course, there are other factors at play than just simply median household income. You want to know growth. You want to
Yeah.
know.
Yeah, what age associated would make a Class A property? Or could there be a 60s or 70s build property, but in a perfect location? Would that make it Class A? If you could just break it down in as much detail as possible, I think that'd be really interesting for the audience to hear.
Yeah. So certainly there's improvement ratings, like I mentioned, A, B, and C. And yeah, you can have different ratings for the location and for the improvement. So for example, you could have a Class C property built in the 1960s, for example, right? Very old asset, but it could be situated in a Class A location. It could be in a really, really premier part of town. So it could be an A location with a Class C property. Or you could have the inverse. You could be in kind of a lower end location, yet have a brand new property there, right? So it just depends on the both improvement rating and the location rating. So that's how we look at it at Lone Star as well. And also just to break it down, right, an A property itself would be something, in my opinion, built usually in the last 10 to 15 years. And then the B range can be quite a big range. You can have B plus, B minus, and that would be something like, 15 to 30-ish years old. And then C would be older. And then, obviously you could categorize something as D, but that essentially is trending towards obsolescence in many people's opinion.
Would a broker ever call a deal class D?
No.
So typically speaking, how do brokers, and this might be interesting, how do brokers spin situations in reference to, or I guess deals in reference to their asset classes? Do you ever hear people that are really silly with their, I guess, phrasing, if you want to call it that, or their spin in reference to the grade? And have you been to, on site where they're calling a deal a class B when you actually know this is like for sure, in my opinion, a C?
Yeah. It's all in the eyes of the beholder, and everyone has their own opinions, but everyone's always trying to fudge the numbers and push things and claim that a B deal is an A deal or a C deal is a B deal, right? Everyone's trying to make their deal look nicer than it really is. So you can't blame them. But yeah, of course, everyone's always stretching there.
Absolutely. So, so what would you, I guess then we've kind of gone to the minutia there, a little off track, but what would you avoid buying? So you would avoid buying, kind of older product or class C product just because there's a bigger spread now. Is that correct?
Well, there isn't a big enough spread. It's
Okay.
still too tight of a spread to make sense of it, right? I'm not that excited to own a very old deal with in a low quality area with low quality tenants. So I would need a big discount to be lured in to buy something like that, right? And right now those big discounts aren't there yet. I think they might be coming. And furthermore, if we do, going back to our economic discussion, experience some sort of recession where people can't afford to pay their rent, or they want to downsize, or instead of living alone, they choose to have roommates, so they kind of group up to make things more affordable for themselves. That sort of activity is going to most negatively impact Class C property. So I think Class C property is what we, for now, want to avoid, as there might be more difficulties ahead.
Gotcha. And then as far as, A properties, if it's newer, is there much meat on the bone for people like us to come in and to buy it? How does it make sense to buy, an A class property or maybe A minus?
Yeah, usually it there isn't much upside in the deal, right? It's a new deal, right? So there's probably not a ton of value add for us to go do. And so there's a mismatch. Not to say it's a bad deal, it just there's a mismatch between our return target and the risk profile of an A deal. You shouldn't be able to achieve, generally speaking, mid-teens returns on buying A-class property. That's just not how the world works, right? If that game were that easy, everyone would do it. And the reality is there's a lot of very smart, big money pursuing A-class property, and they're willing to accept a lower return, right? More so like 8 to 10% IRR. So that's why I'm always not confused, because I know what they're doing, but I'm very skeptical when I see someone buying a Class A deal and then they're projecting 15% returns, right? Because that's just not how the market should function. Now, maybe you got the deal for a steal, and it's a really great deal, but it's very unlikely. In today's market, Class A is at a very interesting place, because it's actually one of the segments of the market that are moving, meaning there's transaction activity in the A space. There's not really much happening as much in the B and C space. And one of the reasons I think for that is because developers are the ones that are building the new A product, and it's in their business model to build and sell. So they're more willing to just take a loss on their development and move on to the next project, right? They want to move on to the next project. They're not a buy and hold investor. So meanwhile, you've got the buy and hold investors owning a 30-year-old asset, and they don't want to sell because they don't want to take a loss, right? So they're just going to hang on tight. But again, that A class space, the developer built it and they're like, hey, I'm just going to sell this for a loss and get out and move on. So we are seeing movement in the A space. However, even though you have motivated sellers, in my opinion, it still most often doesn't make sense to buy those deals just because where debt is. Because Class A deals trade at the lowest cap rates, they're kind of the most impacted by interest rates. And right now, those interest rates result in very negative leverage, right? If you're buying a deal, you might be getting a great deal on it, which means maybe you're buying it for a 5 cap, 5.25 cap even. Well, if your debt is 5.5 or 6%, that's a challenge. So what you're seeing a lot of people do is they're buying not based on the cash flow or the cap rate, and they're buying just solely based on basis. So a lot of people, and I actually kind of like this strategy. If you're really rich and you have a lot of money, then being able to buy deals all cash right now is super attractive strategy, because you can buy deals today at pretty solid basis and just not worry about the financing for now. And then hopefully interest rates come down in the next year or two, and then you can finance the deal. So having the ability to buy cash is a very, very solid strategy in today's environment.
Absolutely. Outside of multifamily real estate, is there any other investments that you would avoid right now, in your opinion?
I only eat, sleep multifamily. So I have no comments outside of multifamily. I'm like SpongeBob in that episode where he went into his brain and he only knows about fine dining and breathing.
Oh my gosh, that's actually, I hadn't thought about that in maybe a decade and a half, but thank you so much for bringing up a fun SpongeBob memory. Very good. Very good. Okay. And I guess we kind of spoke on this, but what you would avoid right now, product type wise, it seems like you would avoid anything kind of class C. Is that correct? Or anything maybe in a rural market? I know on my end, I would not want to invest in anything in a tertiary area, just with where growth trends are going and what gets hit hardest, from a job perspective. That would just really concern me. I would never want to take that risk currently. I definitely would want to be kind of in deals that we're acquiring right now, which are in dense areas that don't have much development coming up. So that's certainly what I would look for. But to avoid on the other end would be anything, slightly risky, closer to the Class C profile, anything with a bad occupancy currently. I just would not want to take that risk currently. How about yourself?
No, I completely agree with that idea. I think it's too early for those strategies. Buying in a tertiary market, I think, will be a good strategy soon enough, but I think it's still too early. And I forget who said this, but being too early is indistinguishable from being wrong, right? So it might be a great idea, but it's all about timing. And I think that you're right. Right now, focusing on high quality assets that we're comfortable holding through a downturn and holding long term. Not to say that we have to be long term holders, but having the right deal strategy, right deal type, and the right capital structure, specifically on the debt side, to be able to do that, which is hold long term.
I think your parents were looking for something kind of not, I guess, a little more on the riskier profile. They like buying in, areas where they can get paid for it. Is their strategy just to wait and see kind of right now? What's kind of their philosophy as they navigate a shifting market?
Yeah, we're not market timers. But with that being said, we're constantly looking at deal flow and seeing what's available in the market. And so here's the thing, right? It's much easier to catch a falling knife than it is to try to time the bottom and then or catch it on the upswing, right? So I think it's all about sticking to your foundation and to your fundamentals and not getting greedy. So if we're looking at deals in the market right now and we find a deal, the numbers make sense, but let's say we're of the mind that prices will go down more in 6 months or in a year. It would be foolish of us to look at a deal where the numbers pencil and we go, you know what? I'm going to pass on this one and wait for when the deal gets even sweeter. That's a fool's errand. You need to catch that falling knife and buy that deal right away. So my parents, Lone Star, savvy investors are ready to pounce and buy deals today, right? We're actively buying right now, and we're actively looking for good quality deals in tertiary markets for my parents, right? So that's another element there, and they're just going to have to be more patient because we're just going to have to pass on more deals, right? Because simply less deals make sense in those tertiary markets. Sellers are asking for ridiculous prices still, and I don't know when that's going to change.
Well, why wouldn't they, right? It's their prerogative. If they don't have to sell right now, give me, it's like a make me move price. But we'll see how that transpires as the economy shifts and debt notes come up, right? So it's all fine until, oh wait, I actually have to get out from under this, otherwise I'm going to be underwater on this property. So no one is, that urgent yet, seemingly, but that will certainly change as the market shifts and change, as we know.
It's interesting. I've never thought about this before, but if I were to bet, I would guess that there's a greater percentage of bridge loans in primary markets than there are in secondary and tertiary markets. So what that means is there's going to be less forced selling as a result of maturing bridge loans in tertiary markets. I could be wrong about this, but I think that is true. And the reason why I think that's true is because historically, cap rates are higher in tertiary markets. So those markets are more financeable on a perm loan basis because there's in-place income to actually lever off of, right? Whereas in the primary markets, things got so heated that if you were buying a deal at a 3 cap, you had to buy with a bridge loan in order to be able to get the leverage you needed because there wasn't enough in-place income for a term lender to give you much proceeds. So
It's great news for us.
That is great news for us. It's bad news for people that want to kind of be a scavenger or look for distressed deals in tertiary markets, right? Because there's less people with maturing bridge loans in tertiary markets that are going to be forced sellers. So that's something interesting. However, on the operational side of things, I think there's going to be more operational, perhaps more operational distress in tertiary markets than primary, because the tertiary markets are generally weaker, right? They have less demand and maybe less robustness, so they're more susceptible to economic downturns.
Gotcha. Awesome. Well, I love this in-depth conversation, this topic. Anything else you want to mention on this before we conclude and go to the next segments or
No,
topics?
let's move.
Cool. So where are you currently?
I'm in Warsaw.
Yeah. How long you've been out there, and kind of give us the feel and the vibe that you've had.
Well, I was joking with our friend Teddy the other day about how much time I'm spending in the hotel. And we were saying, it's like, how was Warsaw? Oh, you mean Marriott? Because I'm just in the hotel the whole time, at the gym, here at my desk working. So yeah, you could call it a vacation, but it's more like I just transplanted myself to another city to live my life, work and work out and go out to eat and whatnot. But it's a nice city. It's been great. The purpose of my being here is a mastermind to network. So I've met with some new people, met with some people I'm already connected with. But as you alluded to in the introduction, we're always, both you and I are always looking to meet with solid quality people and to expand our network.
Yeah. So I guess just give us a Warsaw breakdown, because I'm a traveling sicko. It's my favorite thing to do. What's the food like? Is it a clean city? What cities would you comp it to compared to? Give us kind of the scouting report you've had outside of the hotel in the Marriott, because I don't need to hear about a Marriott.
Yeah, so it's a very clean city. It's very nice. It has Soviet elements, kind of Eastern European elements. So I would say it's probably less pretty than Prague. I know that's important for you. And I would say it's a bit bigger than Prague. So just comping it to Prague, I think feels like there's a little bit more to do, feels a little bit more busy. Also, Warsaw is on the rise big time because of the war in Ukraine. There's a lot of people who have left Ukraine and come to Warsaw. Warsaw's kind of become the hub. So from what I've heard from people, Warsaw real estate is up 50%. Everything is more expensive. There's a lot more people. The streets are busier. And we've even heard that there's more I don't know, Russian and Ukrainian being spoken on the streets than Polish. So I think the city has changed a lot in the last couple of years. So it's interesting, but it is similar to kind of Budapest, Prague, but I do like it.
So it kind of has that Eastern European flavor, you're saying? So it's that architecture, it's kind of just it's kind of, I would say it's distinguishable from, other places in Europe, certainly from French, from Italian, from Spanish architecture. British kind of has a mix, and, the Dutch architectures has its own kind of motif. So it's kind of cool, it is interesting. If you go in America, if you go state from state, it's kind of country to country from a size perspective, there's not much distinguishable factors. But when you go to Europe, you could fly, I think you're ending your trip in London, if I'm not mistaken. Well, England looks a lot separate to what Poland will look like. Similarly, Poland and Prague are separate. And if you go to, Latvia, or if you go to Stockholm, it's going to be slightly more distinguishable as well, which is kind of cool. That's one of my favorite things.
Yeah, it's definitely cool to see different cultures and get out of your comfort zone.
How's the food there?
The food is, I mean, coming from New York, I'm extremely spoiled. So the food here is okay. I wouldn't say it's anything to write home about.
Is it kind of like Czech food? Is it like Russian food? Give us a palette.
There's a pretty good mix here, actually. We even had Korean barbecue the other night,
Did you
but
have some really good pizza the other
I actually had the worst pizza I've had all year yesterday. But that's fine because the city
night?
redeemed good pizza later that day.
It wasn't Prince Street or Joe's Pizza or Grimaldi's?
No, it was not. It was not. But we had Nobu the other day. That was some good comfort food kind of.
They have Nobu in Poland.
There's even a Nobu hotel, yeah.
Wow. Wow. That's I guess it is first world out there.
Well, like our friend Ben describes it, it's a very nice meeting of East and West because there's still Uber here, right? So there's a lot of the trappings of Western culture and modernization, but then it's also old, traditional, and kind of feels like a slower pace, kind of a smaller vibe, which is, good if you're seeking that for sure.
Awesome. Cool. And you mentioned that you're there masterminding, and I actually had dinner, in my opinion, the best valued restaurant in America. And I think you agree with this as well. The best happy hour special. I put oysters, I at least have a dozen. I would say, shoot, once a week minimum. So we went to Buck and Ryder last night on Camelback. It's on 44, basically in Camelback, with some buddies. And kind of a note that I had in takeaway was just the value of your network and being around people who are doing big things. So I met with our friend Chris Boakes, who's running a mortgage company. We actually just did a deal together. And then in conjunction to that, we also was with my buddy Eddie, who is starting his own basically online service for medical folks who are in the medical sales business to audit them. And there's basically no process there, and there's a ton of turnover, and it costs companies a lot of money. So he's kind of solving for that. But it was just really special to be around two entrepreneurial people who are accomplishing a lot in their personal lives and also, or sorry, in their career, and then personal lives are doing very well. So it just goes to show, being around people who are doing big things and are entrepreneurial, it really is infectious. And we'll want you to level up, and you got to raise your game and be your best. Otherwise, you're gonna get left behind from that group. So it's so important to have kind of pace setters and people that are kind of younger, that are coming up, or that are a little bit older than you, that are doing well, that will want to share some wisdom. And I know you're big about that, but maybe share some of the things that you've been kind of thinking about in those regards.
Well, something I'm thinking about is we should host some sort of meetup or get together. When this podcast becomes famous and we're rich and famous, we should host a meetup at Buck and Ryder in Phoenix and share everyone our favorite restaurant in the world, the oyster capital of the world in the desert. So yeah, no, that's all good stuff. I had a long conversation with our friend Ben last night about goal setting, leveling up, pushing each other more, and things like that. And it's really hard to keep yourself motivated. And motivation is maybe the wrong word, because I think motivation is overrated, right? It's all about discipline, actually, not motivation, right? But with that being said, there's a difference between going to the gym and actually cranking at 100%. And that truly is tough to do day in, day out all alone. And that's why it's really great to have peers to push you. And that kind of goes, as you alluded to, the concept of the rule of thirds, which is you want to spend a third of your time with people that are above you, a third of your time with your peers, and then a third of your time with people that are below you. I don't know if the thirds is the right proportion, but I think the idea is just the fact that it's very healthy to spend time with people across the spectrum, right? Peers push you, mentors lift you up, and then giving back, teaching is the highest form of learning, right? So
Well, you're welcome that I get to hang out around you because obviously I'm above. So it's just, you're so welcome.
yeah, exactly. It's mentorship is very valuable, and mentorship can come from above, below, peers. I think the peer thing is the really valuable thing. Ben and I last night were talking about how there's so much value in being able to be honest with each other. And that is, you think you're being nice to somebody by holding back and not saying the truth or not saying something that you think is constructive or criticism of any kind, but you're not actually being nice, right? Because you're missing out. They're missing out on the opportunity to learn and level up. So, you and I have a very open relationship.
I have a lot to add on that because to your point, there's levels to it. So you want to be, if there's other people around, let's say if you're going out, you want to be very complimentary. If you're ever putting your friend down around other people in a socialist aspect, that's not your friend. That's just disgusting behavior, in my opinion. That's not necessary. But when we're having a candid conversation, that's when you want to, definitely give people advice or kind of let them know what you're thinking, or maybe come at it from a constructive way and ask questions that may lead to a productive solution where everyone can, health in a healthy manner, understand perspectives and backgrounds and how, we could all improve. But to that point, that's really awesome. And you did mention something that's great there is you do not want to sugarcoat your messaging and be soft on people if that's truly your friend. And, we've had very brutal conversations and you still will light me up here and there if my hair doesn't look correct, in your opinion, or if my tie is not cinched up, which by the way, for the record, I just want to note the fact that I'm wearing a suit and you're not today. That's a first. But you're in Poland, so I'll give you a little bit of a break. And I'm also meeting with some capital partners later today at Houston's on Scottsdale Road. So I'm excited about that. I'll tell you about that more after this. But it's really interesting where if you're around more elite people, you can kind of, if you're self-aware and you're awake, can audit yourself a lot more quickly. And also you'll kind of be like, wait, oh, they're doing this. Maybe I need to do this. Or they're doing that. I don't disagree. I don't actually agree with that. And here's why. And you can maybe give them some of your philosophy and they can maybe correct their decisions. And maybe you help them get on a better trajectory.
Yeah, exactly. It's very, very difficult to know what you don't know because you don't know it, right? So it's hard. We all have blind spots, and in our business, we have blind spots, and someone can, from the outside looking in, very quickly see, oh, well, I think you can actually supercharge this way, or you need to clean up this, and that can be $1 million conversation.
Absolutely. Switching gears, do you? I'll leave it to you. Any other notes on that?
No.
So switching gears, I have I'm, as I said, hanging on to my 20s by the hair of my chinny chin chin. I don't have any hair here. So it's quickly evaporating here on my end. I turned 30 in end of June. So still have another, call it 10 months left, but something to think about is, my next set of goals. But what are your goals before you turn 30? You've accomplished so much. Is it to get $1 billion of assets under management? Is it to hit a certain net worth goal? Is it to have a certain friends? Is it to have a certain body? You're obviously in great shape. You're financially doing very well, and our portfolio is growing very nicely. But what do you feel like you want to achieve prior to hitting that milestone in your life?
Yeah, it's a great question. Because it's 3.5 years away. So certainly by 30 in 3 years, we should absolutely cross that $1 billion AUM threshold, which I think is very, very, it's a very meaningful round number.
It'd be kind of problematic if we didn't, I would actually say, because we're not going to be selling much. So if we don't, the economy is in a very tumultuous spot.
No, that's highly problematic. That's actually correct. I mean, I would love to hit 2 billion by 30, to be honest. But yeah, no, you're not going to complain. Nobody's complaining, but we'll take what the market gives us and we'll grow it at the right speed. But yeah, a billion's a nice round number. And having that size portfolio is really valuable because it will allow us to continue to add personnel and add robustness to our infrastructure and improve on our vertical integration, on the property management side of things, on construction management and things like that. So yeah, that's all great stuff. And I think that's all in motion. So I don't really look at that necessarily as a 3-year goal per se. I look at it in annual increments, right? So we want to buy, let's say, $250 million in deals in a given year. And that's kind of the goal that we need to set and chase for the year, and then kind of break that down into quarters and whatnot. So yeah, that's definitely a big goal. Otherwise, I don't really have any really big goals. Right now, I'm super into boxing and I'm itching to get back and do more boxing. I had to take some time off because of my nose surgery, and I'm looking forward to getting my nose all healed up so that it can take punches to the face again. But yeah, that's something I'd want to really kind of invest and do, like a sprint, do a ton of boxing and really kind of set up my foundation, and then maybe scale back again. So kind of go up and then go back. Something else that just kind of popped into my head, which I think is really important, and this is more of a habit than a goal, but I'm working with Daniel Kelly. Shout out Daniel. He is a kind of a optimized coach, a wellness coach, and we're working on optimizing my lifestyle and my blood work and things like that. And something very simple that we're doing is, just in an effort to get more sleep, taking my phone and putting it in the kitchen before bed, an hour before bed, and retiring to my bedroom and reading and going to sleep, and then trying to get more sleep than 7 hours.
Well, you have a TV in your room now, so you have a screen there. Although it also acts as a beautiful piece of art. It could be a Monet, a Picasso, or a Van Gogh, but that is different. But I know when you sent out your, I think you wrote in the newsletter to start the year, that was one of your goals. So maybe you went away from it and you're coming back. Is that correct?
Yeah, no, it's been working better now. Obviously, while traveling, things go out the window, which I know is a limiting belief. I can't let travel be an excuse and say, oh, well, I'm just going to throw my routine out the window because I'm traveling, right? That's a limiting belief.
You travel so much, as do I. So if you think that's a good, or if one travels at the clip that you travel at and I travel at, and you're just going to throw out your workout routine, you're really going to fall behind and you're going to be out of rhythm. So, it's funny, when I was just in Nashville and New York, I worked out every single day. I missed all but one day. And that was due to a blood drive that we were hosting, due to meeting with investors, and then doing a podcast on top of that. So I do not have legitimately a second in my day for myself to conduct that workout, which it still makes me mad, because I look at my habit tracker and I'm like, shoot, I missed that day. And it does genuinely, to my core, bother me. So when I'm home, like now, I woke up today at 5:30 and I biked around my neighborhood because I'm nursing an ankle for about 40 minutes, prep for this podcast. And then our buddy Weston is coming to town tonight. So I'm sure we'll swim together, work out. I'll hit my 100 push-ups and sit-ups prior to getting over to the gym, just to get my body engaged. But, one really needs to iron that out, especially if they're traveling. And, it's another X factor in there, but it'll challenge not your motivation, because motivation is, not BS, but it's, comes and goes. It'll challenge your discipline, and discipline is so crucial for everything in life. And I think one thing, back to the friend conversation, was just, these guys are successful, and I consider you incredibly successful, and myself. And I think the one common theme that I think we all have collectively is, every single day we just showed up and wanted it. And some days you're going to do better than others. Some days you're more motivated. Some days are more impactful and have more momentum. But just being consistent day in and day out, and inching forward and not veering off the wrong path and going a mile that way, which puts you, then you have to come a mile back and revert here. But just moving every single day with a goal in mind and a vision will really take you places. And just doing the little things right every single day will really just level you up. So I guess in your goals, so you have a life coach. Obviously getting it to $1 billion is the goal, but that's seemingly inevitable. That should probably happen by the time you're 28, would be my guess, 28 and a half, I would say. and then really scaling from there, especially if we're not exiting anything portfolio, and then boxing. Anything else that I'm missing?
No, not really. I mean, we're always making moves over here on the watch collection, so that's always in progress, and will continue to be. But yeah, no, life is really good. I think it's all about the process and just enjoying the day to day. So rather than goal setting is tremendously valuable, and I don't do this as much anymore, and I honestly don't have a reasoning or excuse for it or excuse, but I used to, and I've talked about this a lot, write my goals down every single day religiously. I would gratitude journal, then I would write my goals down, and then I would write my top activities for the day that are going to bring me closer to those goals, right? So goal setting is tremendously valuable because it really just harnesses all the day's energy towards where you need to be going. However, with that being said, I also think there's a lot of value in optimizing your daily lifestyle, right? Goal setting is, hey, I want to get to a certain amount of net worth by this. Well, that's not really a place or a feeling or anything. Like, you get to that net worth number and then you kind of look around and nothing's changed, right? So I think not just the goal setting, but also optimizing what your everyday looks like, right? What does your custom made reality look like? And really being intentional with how your day looks.
Yeah, and I'm fortunate where I do work remote, but I get all my work done. So a lot of my day revolves around, number one is work. And then number two, a big goal for mine is getting into the best shape of my life. So I can kind of tailor my day around, making sure that I eat the right things, making sure that I get all my work done and I don't miss a meeting, and then making sure that I work out twice a day. There's no reason for me not, or excuse to hit any of these goals and to not become my best self. And that starts with just my habit tracking and getting that dialed in, especially, I have a little foot injury right now, which my body has had no ailments. I've never broken a bone. I feel really fortunate. But when you are in a situation where you're kind of nursing, because I was doing about 10 miles a day for about 6 weeks. When you are in a situation where you're a little bit immobile, it really puts things into perspective and makes you appreciate just being healthy and feeling good. So that's something that I mean, I'm about 95% back right now, but something I will not take for granted, and something that will put things into perspective on my end. So something definitely to think about is, making sure that your body's taken care of. And on my end, before I turn 40, from my vision, eventually I would like to start having a family, getting married, whatever that looks like, having a couple kids, having about a net worth north of $5 million is kind of my goal at that point in that age. And then having a house in Arcadia proper. It's a neighborhood in Arizona that I love. I adore it. It reminds me a lot of our hometown. It's like a mix between Menlo Park and Lindenwood, in my opinion. Maybe you could agree or disagree on that one, but I think you kind of get the feel for what that looks like. So those are kind of some of my goals. And then also just staying in impeccable shape and enjoying a country club out here. So really just planting my roots in Arizona. And then, starting a family would be, that's something that I not rushing into by any means. Actually made a pivot in my life recently, kind of swaying away from that. But it's definitely something that as one gets older as a man, I think it's something you think about, and having a legacy and, creating something bigger than yourself, and really, providing, giving back to people and being fully selfless. And, when that time does come, I'm, when the timing's right and when the stars align, as they say, I really do look forward to that.
You're such a lover.
I am, unfortunately. I'm a good friend, as you know. So if you're friends with me, you get a lot of love. You probably get a lot of calls as well.
A lot of calls and love. Very good.
Yes. So I'm going to end it on a more somber and heartfelt note. Our fearless principal and leader, Rob Beardsley, got diagnosed with a terrible sickness. It's the Patek Philippe disease, where it's a new variant. Before, he got bit by the Rolex bug, and now he got bit by the Patek Philippe bug, and he's going through a whole rotation. His bills are crazy. His desire for Rolexes is diminished. He's beaten that one, but now it's all Pateks, and he can't sit still with these things. It consumes him. It's like you're going through a manic episode with these watches. So why don't you break down your newest conundrum and your disease that you got diagnosed with?
So I first and foremost have to say that I still love Rolex. I think Rolex is great. But with that being said, Patek Philippe really is truly so special and has now taken over my watch portfolio. And all the new Pateks are coming in and they're asking for all the Rolexes to politely leave, which is very sad, but one must evolve. And so that is the direction we're going. I don't want to spoil things or share too soon, but I would say give it maybe 2 more podcasts and we'll have some new interesting things to share. So yeah, it is, as Kevin O'Leary says, watch collecting is a very bad disease, and I don't recommend it to anybody.
Is it contagious?
It absolutely is contagious.
Is it gonna rub off on me? Am I gonna have to sell and put, or get a HELOC on my house to buy the cool pieces as well? What's going on?
Yeah, it just might. It just might.
Yeah, happens to the best of us. Awesome. Well, any final thoughts before we wrap up this episode?
No, I just am grateful that we have a great team and specifically great marketing team with great editors. So hopefully they edit all of the bad Wi-Fi mishaps on this podcast, and let's pray for better connection on the next show.
Absolutely. Well, if you need to get a hold of us or me specifically, if you're looking to invest, raise money, or have a referral for us, please reach out to myself, craig@lscre.com. If you have any questions for the mailbag or just want to learn more about us, please reach out to me. Once again, Craig@lscre.com, and we will catch you on the next show.